Morning, guys. It's Thursday, August 28th, 5:24 a.m. Central Time. Grain markets are mixed this morning. December corn futures up a half cent at 406 and a half. November soybeans down 1 1/4 at 1046 and a quarter. December Chicago wheat down 1 1/4 at 523. December Kansas City wheat down 2 1/4 at 510 3/4. December spring wheat down 3/4 of a cent at 576. We've got some more rumblings of direct farm payments on the horizon. Let's start there this morning.
Speaking at the Farm Progress show on Tuesday, Deputy Ag Secretary Stephen Vaden said the agency is exploring a bridge policy to provide short-term relief until stronger price supports under the new Farm Bill take effect in 2026. He noted that key programs such as ARC, PLC, and enhanced crop insurance will not begin until next year. The Commodity Credit Corporation, which is set to be replenished in November, could serve as a funding source for the bridge policy, much like past trade war assistance. Vaden also underscored the need to boost demand by expanding trade and emphasized the administration's commitment to opening new markets for U.S. farmers.
We don't like this. I don't like this. Farmers don't like this either. What farmers want are markets that provide them an opportunity for profitability. And they're not asking for a lot of profitability. They just like to see a little bit of ROI, but that's not possible this year because of a number of factors. I know we're going to have people jump on and say this is all Donald Trump's fault. And do the tariffs on China have something to do with this? Yeah, they absolutely do. But we've also gone a couple of years without any sort of real weather issue in the United States or in Brazil, which has resulted in massive oversupply. The current bear market in the corn and soybean markets and in the wheat market also, and the current farm economy recession, as I would call it, predates this Trump administration. It really dates back to probably the late part of 2022 into 2023. 23 was a bad year, 24 was a bad year, and 25 is shaping up to be perhaps the worst year of those three. So they're talking about some sort of trade war relief payment. I thought this was maybe a good time to do a history lesson on MFP and what happened last time around. So last time around, China announced a 25% tariff on U.S. soybeans in April of 2018, and the tariffs were implemented a couple months later in July. In August of 2018, not very long after that, USDA announced the market facilitation or MFP program. Signups began in September of 2018. Payments went out shortly after that, depended on when you signed up, essentially. There was a second tranche and a third tranche announced in December of 2018 and February of 2020, respectively. This was mainly a soybean thing. If you guys might need to zoom in to see the numbers there on the left, but it was mainly a soybean thing. So that the payout for soybeans was $1.65 per bushel. And the way that it worked was that I believe 50% of that payment went out with the first tranche, 25% went out with the second tranche, and the remaining 25% went out with the third tranche. This was not a corn thing. They gave you like a penny per bushel for corn because the trade war mainly affected the corn market. And you could say the same thing about this trade war right now. There were a whole bunch of payment limits. MFP payments are limited to a combined $125,000 for corn, cotton, sorghum, soybeans, wheat, and capped per person or legal entity. So there were some limitations. And this is why we have done videos in the past, very recently, as a matter of fact, with Paul Neiffer about entity setup and how you guys as farmers really, I can't emphasize it enough, you need to maximize the number of payments that you will receive in these programs. Again, I don't like it and you don't like it either, but this is the game that we're playing. So if you're going to play the game, and you will, you better play it well, and you better have your entity structure in line. So I think this is something that's coming. If you were to draw the parallel to go back to the timeline, China announced tariffs on U.S. soybeans in April of 2018. This year it was March. It was actually a month earlier this year here in 2025 than it was in 2018. So I think that the government needs to, I hate to say it, they got to get their shit together and announce whatever this plan is, because it will have impacts on your marketing. If you're a soybean grower and you got a cash bean bid at $9.50, it kind of sucks, right? You're a couple bucks below production costs. If the government steps in tomorrow and tells you, hey, we're doing MFP, it's going to be $2 a bushel, you can go and market beans, you can count on the MFP payment, and you can say, hey, I broke even, I'm going to cash flow, I'll farm again another year. This is getting really dicey, guys. I'm hearing things from ag lenders and people in that space that like a massive percentage of their operating loans won't be renewed next year unless something really happens. I mean, we're talking 15, 20, 25, 30% in some instances is what I'm hearing. So as much as I hate to say it, and as much as I hate to discuss this, I'd much rather have good markets to deal with and improve demand, right? It's not there. So this is reality. I don't love it, but that's the deal. We've got some more China news.
China continues to rely on Brazilian soybeans despite their premium over U.S. supplies. With the U.S. harvest approaching and the export season set to begin in September, China has yet to make any new crop U.S. soybean purchases. Instead, the nation is relying on Brazil's ample stockpiles to meet the majority of its near-term demand. Brazilian soybeans, however, are trading at roughly a 20% premium to U.S. beans, raising costs for Chinese crushers that bypass U.S. supplies. To mitigate this, China is further diversifying its supply by increasing soybean meal imports from Argentina while also reducing the amount of meal used in livestock feed.
Mackenzie, you wrote this copy. Clarify this for me. Brazilian soybeans are trading at a 20% premium to U.S. beans.
So they're 20% more.
Brazilian beans are more expensive, yet
Yes.
China is avoiding U.S. beans. China is the one imposing the tariffs on soybeans on their own buyers. So people have asked the question, why would China buy U.S. soybeans? It's because they're cheaper. And the Chinese government can waive those tariffs as they have in the past, and they can buy the beans from the U.S. and they can do it at a discount to Brazil. That's why China would buy U.S. beans. It's simple economics. Here's a couple of statistics for you. This past marketing year, China relied on U.S. soybeans for essentially 2 months worth of soybean needs. China uses on average about 11 million metric tons a month of beans. They've got a total domestic use number, according to USDA, for this current marketing year of 133 million. China has imported 22.5 million tons of U.S. soybeans during this current marketing year, which ends here in a couple of days. So the question is this: will China be able to fill that hole of, call it 2 months worth of use, 20 to 25 million metric tons, if they avoid U.S. beans and buy only from Brazil? Because if they don't import that 20 or 25 million from the U.S., they're going to draw down their ending stocks by a significant amount if they can't buy the beans from Brazil. And this is one of the big questions floating around right now. USDA's got their ending stocks number pegged at 43.5 million, and say they import, call it 20 or 25 from the U.S. I mean, they could chop their ending stocks in half if they can't fill that void with Brazilian soybeans. So this is one of the questions that's floating around right now is what can China actually accomplish with regard to soybeans and imports without really damaging their stocks. And they like keeping high stockpiles. They don't want to draw down their stocks. So this is one of the questions. The meeting between U.S. trade negotiators and Chinese negotiators in Washington is supposed to be either today or tomorrow. I have not seen an update on that, but I'm assuming we'll probably be talking about it either tomorrow morning or Monday morning.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video with Matt Bennett?
Matt Bennett was on yesterday. We did a whole bunch of grain marketing stuff, unsold bushels, be it old crop, which unfortunately there are a bunch of old crop bushels still floating around, new crop bushels, basis contracts, spreads. We talked about the MFP payment amount a little bit, which I discussed earlier. Always great grain marketing stuff with Matt. We have some fantastic questions that come in from our premium crowd. Today, we're going to be talking about ag lending, and I've got a lender coming on to talk to us a little bit about the current environment, which is kind of scary, but you guys need to hear it. If you want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody tried to say anything else. People sometimes email me and they say, Joe, where am I going to get my ROI on this $50? The one video about entity setup, if you weren't aware of it, is going to save you like hundreds of thousands of dollars. The stuff we do on crop insurance is going to save you like a ton of money. The budgeting stuff, I mean, if you watch one of those budgeting or transition planning videos, this thing's going to pay for itself for 10 years. So we put out information that will help you to make decisions. Grain marketing is a piece of it. I do put out cash grain marketing recommendations. I have good years and bad years, just like everybody else. The one thing that I do that most people don't do is that I'm super transparent about it. And I'll tell you where I went wrong and where I went right. More so I focus on my wrongs because that's how I am. I hate myself and I talk about the things that I've done poorly. But in any case, you guys should give this deal a shot. Sign up this morning. I'll forward you a copy of this morning's email.
Vietnam plans to fully transition to E10 gasoline next year. The move is expected to increase imports of U.S. ethanol and corn as the country attempts to reduce its trade surplus with the U.S. To support the shift to E10, Vietnam cut its ethanol import tariff to 5% back in March, down from 10%. The country currently operates 6 ethanol plants, but their combined production meets only about 40% of domestic E10 demand. Vietnam also pledged to increase imports of U.S. farm products by $2 billion.
Let's go. Rock and roll. We need more of this, though, because Vietnam itself is probably not going to be enough to move the needle. But the government has dragged on the stuff with sustainable aviation fuel. A lot of the airlines are actually backing off. We ran a story a couple of weeks ago about Southwest and how they actually sold their renewable business, or the business that was tied to sustainable aviation fuel. So I think that if we're to improve demand for U.S. ethanol and therefore U.S. corn, the export route as it relates to ethanol is probably our best and most realistic shot right now, especially if some more trade deals are struck.
U.S. ethanol production declined last week. Weekly output of 1.07 million barrels per day was down slightly compared to both the prior week and the same week last year. Ethanol stocks fell to 22.5 million barrels, their lowest level so far this year. The print was down 1% compared to the previous week and down 4.3% compared to the same week last year. According to Reuters data, U.S. ethanol production margins remain robust.
Yeah, the numbers are good. Although, we're at the tail end of the marketing here. I don't know that there's anything here that tells me that USDA needs to adjust this ethanol number. We'll get a little bit more interested in the new crop corn number via ethanol.
Mexico will impose tariffs on Chinese imports. The move is part of the nation's 2026 budget proposal, aiming to shield domestic businesses from cheap imports. The move also aligns with President Trump's request for Mexico to raise tariffs on China, similar to what the U.S. has done. Specific tariff rates have yet to be announced. Mexican officials have also suggested restricting shipments from China and strengthening trade and manufacturing ties with the U.S. and Canada. All three countries are set to review the USMCA trade agreement negotiated during Trump's first term by the middle of next year.
So I guess Mexico is our buddy here, and we need them to be, because they buy a lot of corn. They've been buying soybeans. They've been a great trade partner for U.S. agriculture, and we need that to continue. I'm not sure how Mexico and the U.S. ganging up to tariff China is helpful, though, grand scheme of things. But we need to keep Mexico friendly.
The S&P 500 closed at a record high on Wednesday, rising 0.2% to surpass its previous peak set just 2 weeks ago. Anticipation of NVIDIA's quarterly results released after the close drove the rally. The AI company reported better than expected earnings and revenue for the second quarter. Strong demand for AI infrastructure continues to support the company's outlook. The Dow Jones and the NASDAQ were also higher on the day, gaining 0.2% and 0.3% respectively.
Long story short, if the Fed is going to cut rates, which I believe they will on September 17th, owning stocks has proven to be a good thing. That being said, the S&P is approaching kind of the upper end of this very long-term multi-year trend channel. Maybe 6,700 is the target. Maybe it's not. The S&P is up 10.2% year to date, 34% from the tariff scare low in April, which a lot of people sold the market and sold their investments because they thought the tariffs were going to ruin the country. And that turned out to be a bad trade in hindsight, of course, up about 16% over the past year. Speaking of ROI with the premium subscription, to go back and do a little ad for you, we have done so many investing videos over the years because I believe, and some of our contributors believe as well, that you need to diversify your investments into some off the farm, non-agriculture related stuff. And we've talked about the S&P extensively over the years, index funds, how to do it, the right way to do it, the wrong way to do it. It's good stuff. What did cattle do yesterday?
Cattle futures were higher once again. Live cattle were 7 cents to $1.32 higher. Feeders saw gains ranging from 35 cents up to $2.22. Box beef prices were lower. Choice was down $1.33 at $411.84, and Select was down $3.05 at $387.71.
The Dow's up 60 points. The S&P is about flat. Treasury is about flat. U.S. dollar's off a little bit. Crude oil is down 26 cents in the October WTI at 63.89. Have a great day, guys. We'll be back on Friday.